Ladies and gentlemen, welcome to the AppLovin earnings call live stream. We are also going to be talking about all the other companies that are reporting earnings. Okay, so it's not just going to be AppLovin, it's going to be ARM, it's going to be Coherent. And what I'm thinking I'm going to do, Jaja, I'm trusting you that this is a video call. They do it via Zoom, so I think you were right there. However, if, for example, AppLovin is flat or maybe down or something like this, I don't have a stake in this company, nor do I have a stake in ARM or potentially any of the other names that are reporting today. That I'm going to be a little bit flexible on what you guys want to listen to today, as long as it's tied to what my portfolio is thematically. So I'm fine with the semi names. I'm fine with the advertising names. I'm fine about learning about Chime. This is another one that's at 5 o'clock. But yeah, we will see. Now, in terms of the earnings call times, we have, I think, AppLovin's at 5. IonQ is at 4:30, I'm pretty sure. So we might also listen to a portion of that call as well to hear how customers are ramping up, who's using their products, how that's getting along. That could be quite exciting. But NVIDIA 207 on NVIDIA. It's looking really good. Let's listen to Realty Income. Not here, my friend, but best of luck to the O investors. Okay, let's plug in the companies that we will be listening to today. We have Snapchat. We have Kratos. We have Axon, ARM, AppLovin, IonQ. We have Chime. We have Coherent. We have DoorDash. What else? We have Energy Fuels. What else? Redwire. Sezzle. Warner Brothers. I don't even think I care. Bros. Dutch Bros is on. Sunrun, do we care? COHR Scientific. Fastly. These are some very, very fun names that are reporting today. Whirlpool is also today. What else? Fortinet is today. How did I miss that? Symbotic. Is that a good list? Is that a good list, ladies and gentlemen? We've got Sunrun and Paycom and stuff like that. I just don't know if we like Flutter. TKO is today as well. Wow. Holy crap. We've got a lot today. TKO, Flutter, H&R Block. Wow, Cirrus Logic is today? It says Cirrus Logic is today. We'll keep an eye on them as well. Barrick Gold. So many names. Oh my gosh. I'm just keep scrolling and scrolling and scrolling. Okay. Let me know through the call or through earnings if I'm missing anything. Aurora Innovation. Okay. Is Oscar Health today? I don't see it. I don't see Oscar Health. But that's the list that at least we will be looking at. Nebius 195 today. Guys, I'm going to have to roll. I'm going to wait a bit. I've got months, okay? So I'm not going to look to roll just yet. Not even remotely close. But, yeah, we'll see. I don't know this company. Should I buy before earnings? They are an advertising company. But no, I'm not an advocate for telling you what to buy. But when is the earnings call for ARM? That's at 5 o'clock as well. We can listen to ARM, but I'm going to see what the call or like how the performance of the stocks is before I decide which stock to listen to. So AppLovin was a little bit more of a placeholder than actually deciding that I'm going to listen to AppLovin. If they're up a ton after earnings and they put up good numbers, I'll listen to them. If ARM does what the market is expecting ARM to do, we can listen to them as well. The company that I actually want to listen to is Coherent. ARM is the most interesting one, I think, today. But, yeah. VST, I didn't see VST in my list. I do see Clove here. I don't see VST. Wow, only $1.4 billion on the freaking SPAC. Okay. That I think is our full list. There might be one or two that I'm missing. Who knows? So going into it, we have a lot of high flyer names. IonQ is up 11%. Redwire is up 11.8%. Energy Fuels 11.6%. Core Scientific is up 10.4%. Nebius up 10.4%. They're not reporting earnings today, but there are a couple other names that are flying today. Let's keep in mind the actual S&P 500 is breaking all-time highs once again. Yeah, actually, this is something that I said I was going to do, and if all is right, I probably will be exiting Chime. So unless it was a blow off the top, raising guidance, they see something super excited into the future, this will be my last quarter in Chime. I wanted to see Q1. It should be a really, really amazing quarter. Yeah, this is Q1. Holy crap, time flies. So yeah, we will be following that as well. New all-time high on the S&P 500 right now as we speak. Big candles. We got a couple minutes into the close, 6 minutes to be exact. Huge rush in semi stocks. Honestly, a little bit too crazy, even though, we are betting a lot on these names. AMD being up to $418. It was a very, very big beat on guidance. 35% versus 18% is a huge raise. Jack says, Nebius erupted all over my portfolio. I'm still mopping up. Got a towel? I don't have a towel for you, brother. You're going to have to figure that one out on your own. I'm rolling options every day, it seems. It's a good feeling, though. It's a good feeling having the pressures of making too much money, more money than you thought you were going to make. It's a good problem to have. That's essentially what a covered call is. Like whenever you have to roll out a covered call, One second, I'm going to blow my nose. Okay, sorry about that. Whenever you have to roll out a call, it's like essentially saying, oh, okay, wow, this company, I'm making way more money than I thought I would in a shorter time span. I'm going to have to roll out so then I can make more money and get paid to do so. Coherent gang. Yeah, we can definitely switch to Coherent if they end up putting up a really big quarter. I think I want to listen to Coherent the most because I think that is a space that in the next generation of GPUs and chips in general are going to require so much more photonics, right? That's why NVIDIA created their photonics chips. I think it's going to be big for their networking space. It's going to be big for their chips. And that's seeming what the next generation is going to have. So we could have a big, big explosion there. Everyone's here for IonQ? All right. Guys, I'm praying for you. I can listen to a quantum quarter. Don't get me wrong. Do not get me wrong. Okay. Do I have Fastly up? Yeah, Fastly is here as well. We've got Fastly. Where is it? Chime's up even 4.5%, 21. Coherent's up 2.4. Energy Fuel's up 11.6. Redwire's up 11.8. Where is Fastly? Down 1.8%, 31.76. Still up 440% over the last year. TKO's up 2%. Aurora Innovation's up nearly 11%. AMD's up 18. Pretty crazy. We have Remitly as well today. So, wow, dude, we are touching. Like we're almost at 7,400. Like this happened so fast. The S&P 500 is up 11.6% in the last month. That's crazy how much we sold off because of the Iran war, chances of higher hiking rates, and now we're up 1,000 points since then. Shouldn't you be watching Nebius price action? For what? Is it climbing even more? I should be watching Nebius's price action. Oh my gosh. What the heck? Whenever Nebius moves, it means so much more to my portfolio than anything else. Like, it's nuts. We will see if they close out the day quite strong here. We got 50 cents or 50 seconds left, and NVIDIA's looking to close above 208. Not the highest close we've ever seen. We've seen them get up to $216 during, during the market while it's open, intraday, which was also quite recently. But right now, it's another very green candle. We'll see if they can hold it. And then we're off to main guidance here. Yeah, what did I say? I mean NVIDIA. What did I say? NVIDIA is the high, like by far the biggest position in my portfolio. Sorry if I said something else. That's not dyslexia. I just said the wrong thing. Okay, sorry. The market is now closed. Kratos is up 2% already. Let's go and hunt down the numbers. No more joking. We have to find numbers now. Yeah, Kratos is immediately out. That's why it's up. Oh my gosh, they got numbers out immediately. 16 cents of EPS versus 13 cents expected, beat by 23%. And revenue was also a beat of 7%. $371 million versus $345 million expected. That is a great quarter from Kratos on the top and bottom line. Hopefully we can get a little bit more detail here going forward, but that's what we have so far. Snapchat immediately showing up 1%. This could just be jitters though. I don't have any other numbers. Sezzle up 6%. That's most likely. Numbers are out, but I don't have them just yet. Up 6 is a big move. Wow, it's pushing even higher. Up 7%. What else? Cirrus Logic down 1.6. Symbotic down 5%. Sezzle up 9%. Who's in this name? Warner Brothers earnings are out. Flat in line on revenue. It says EPS missed by 11,000%. So something else is there. I'm curious if that has to do with the acquisition. Them paying out those fees maybe to Netflix maybe. That's probably what that is. Sezzle is now up 15%. Who got this name? Who has this one? I only have Kratos and Warner Brothers right now. In terms of the numbers. But the real big mover right now is Sezzle. Fastly up 4%. Let's see the numbers. Come on. I know Sam's in this name. Axon double beat. Small double beat, but still EPS came in beat by 1%. And revenue is up 34% year over year, beat by 4%. Wall Street wanted $780 million. They got $807 million. So that name is looking good. And Axon is down on that news. Kratos up 7%. Axon slightly down right now. Symbotic missed on EPS by 86%. Wall Street wanted 7 cents. They only put up 1 cent of EPS while beating revenue ever so slightly by 2%. Okay. Yes, Sezzle's the big winner for sure so far. Who's in the Axon name? ARM starting to move. Do we have ARM numbers? ARM is out, double beat. EPS came in at 60 cents. Wall Street wanted 58 cents. That beat by 3%. EPS is only up 9% year over year. Revenue, however, beat by 1%. Revenue's up 20% year over year. Wall Street wanted 1.47. They got 1.49. So slight $20 million beat. All right. Definitely not an AMD-like report. Maybe the call will be better, but that is whatever. And now we're headed down. Sezzle is a buy now, pay later name. I think the buy now, pay later that you do on Sezzle affects your credit score or something like that. That's like their differentiating factor. IonQ down 1, nearly 2%. No numbers there just yet. What about AppLovin flat on the day? All the big names not moving too much. Axon falling 4%. Kratos up. It's going down, 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 down. All right, I'm not doing that. I'm sorry. Okay, let's see what else. Fortinet, wow, exploding right now. That just hit up 10%, coming back down a little bit. I don't have numbers. Zillow also showing up 5%. DoorDash down 3%. Coherent up 1%. Come on, Coherent. Chime, potentially flat, up 8% on Chime. That's why we did a Q1 trade. Let's hope it holds. But my idea was that if this was going to be the biggest tax refund of the year, Chime has a massive benefit in that, and they realized that benefit in Q1. That's the hope there. We'll see if that sticks. If not, it might not have been as good of a trade as what I wanted it to be, but we did get in the $16 range. So we're sitting fine. It'd have to come way, way down. IonQ down 3%. And ARM down 3% as well. Axon down 3.3%. Kratos up 4%. Wow. Okay, not crazy moves from the big names. The big winner here today so far is Sezzle up 14. I'll keep you updated on Snap. Don't you worry about that, my friend. Also, is Snap even up here? Where's Snap? Snapchat. Up 1%. Coherent, double beat. Very, very, very small beats. EPS beat by 1%. EPS is up 55% year over year. And revenue also beat by 1%. That was essentially in line, honestly. Revenue grew by 21%. Light or Lumentum, definitely looking a little bit more, much faster growth there. Flutter up 8%. Wow, let's get these numbers here. Dutch Bros is also out. Dutch Bros, sorry, I have it right here. Looks to be a big or a decent double beat. EPS beat on by 3%. Sorry, no. I apologize. Let me repeat. Dutch Bros beat revenue by 3%, EPS by 7%. Revenue is up 31% year over year. AppLovin, double beat, very small, but growing very fast. Wow, Fortinet skyrocketing up 21%. That's the big beat, big winner today. Chime up 9%, 2370. Okay. AppLovin, EPS, they wanted 346. What we ended up seeing, 356. Beat by 3%. They got 10 cents more of EPS than expected. EPS is up 113% year over year. Revenue is up 59% year over year, beating by 3%. 59%. To grow EPS at 59% and to grow revenue at 59% and EPS grows by 113%, that is a very, very fast growing business. Market cap still 160 billion. IonQ is out. Where is IonQ? That one is now up 7%. EPS, listen to this, beat by 500%. Wall Street expected negative 52 cents. What they ended up seeing, $2.07. Wow. Revenue expected at $50 million. We saw $65 million, beat by 30%. Revenue is up 755% year over year, and EPS is up 1,600% year over year. Very, very small base, so you got to keep that in mind. You're only bringing in $64 million on a $20 billion name, but they still beat EPS, or they still beat revenue by 30%. Clover Health. Some small tweaks. Okay. Let's see what else. Fastly. Oh, no. We were counting their win here. Up 3%. Now down 27%. Sam, what is he doing? Oh, no. I don't know if he's actually holding that name. I know that he was putting up a bull case on Amit's show. DoorDash up 10. I'm getting a little report here from Kratos up 2.7. They beat on revenue, beat on adjusted EBITDA, beat on adjusted EPS as well, all across the board. Bookings came in at $605 million, backlog at $2 billion. They raised full year guidance. Everything's looking good. You know what's keeping down the stock? They raised full year guidance, but Q2 came in slightly less. I don't even know if you can say that. 400 to 410 was the range, but Wall Street wanted 409. So technically they did come in, like the midpoint of that range is lower than what Wall Street wanted, but I wouldn't worry about it too much. They came in higher than full year. That's the main point. Okay. ARM's starting to blast off here. 6-7%. I'm curious what came out in that call here. I'm pretty sure IREN's tomorrow, brother. Snapchat beat on EPS by 29%. Revenue missed ever so slightly. The smallest of smallest misses. You can honestly say it was in line. Revenue's up 12% year over year. EPS up 38% year over year. AppLovin up 5. ARM is up 8. Fortinet is up 17%. Snapchat down 6. IonQ is up 2%. Flutter up 6.5% right now. What an exciting... We have so many names being covered today. Not any super big names, but overall, a good showing across the board. DoorDash, we have numbers here. Well, the stock is going up 9%. EPS beat by 17%. Wall Street wanted 36 cents. They gave them 42 cents. Beautiful quarter. And actually a miss on revenue, but revenue is up 33% year over year, but slight miss, 3%. Coherent falling now. Wow, finding lower prices on Coherent. Is anyone buying this up? This is a NVIDIA stock. They own this company. They're green on it. They bought it a little bit. If you were to have bought this company a month ago, you're still up 36%. I wouldn't be crying. But obviously, you want good things for earnings. App in full swing. They coming back down? Wow, Cirrus Logic still flat. Core Scientific down 6.6. Energy Fuels flat. AppLovin still up 7%. I mean, if you're an AppLovin shareholder, you still got to be AppLoving that a little bit. Snapchat definitely recovering. We got down to $5.57. Whoever sold those shares is kicking themselves right now as it recovers. Fortinet up 18%. Fortnite, bro. Fortinet. I lost all my gains on Fastly. That one hurts. Where are we on Fastly? Is it recovering? A little bit. Are we coming back? Dylan, brother. Come on, I'm hoping for you. Let's go. Let's bring the green back. Down 20%, but... Oh. Okay. Let's get the Fastly numbers. I don't have them just yet. Axon did a beat and raise once again. Fastly quarter looks like a double beat. Revenue and EPS, but guide came in line, if not even a slight beat. Honestly, I don't know why it's reacting this way. Let's see if I can find any additional information. Our first quarter performance demonstrates continued discipline and velocity as we delivered record revenue, gross margin, and RPO. Driven by an accelerated innovation roadmap, we delivered 47% year-over-year security revenue growth. This performance reflects expansion within our installed base and robust new business wins, enabling us to raise our 2026 guidance. That doesn't sound like a stock that should be down 20%. That might come back. Who knows? Fortinet's doing very well. We're very pleased with our excellent first quarter results, exceeding the high end of our guidance through strong execution and broad-based demand across our portfolio and geographies. Billings grew 31% year over year, driven by continued convergence of networking and security, an approach Fortinet has led for 26 years, and by an increasing complex threat environment that is being intensified by artificial intelligence. I never understood why some of these security names sold off on AI being a threat to security. Doesn't that mean that people are going to be doubling down? Like that just seems obvious to me. You know? It was priced in. Yeah, I mean that's fair. Fastly's been growing. When do we fire the Snapchat CEO? I don't think you can, right? Isn't that the whole thing, that he owns like the major voting share? I think he has like founder shares. Coherent down 7. DoorDash up 9. ARM is up 8%. Oh, wow. Chime is coming down. I like them better at 23. Let's go. So what do we want to listen to? Do we want to listen to AppLovin? Or is there something in here that you would prefer to listen to? The only thing is, like, ARM's moving, but like they practically came in line. ARM delivered record-breaking results this quarter and in their full fiscal 2026. Revenue this quarter was a record $1.5 billion, our highest revenue quarter, above and beyond the midpoint of our guidance. Above and beyond the midpoint. As AI becomes more agentic, demand for ARM AGI CPUs, ARM's first data center chip, has exceeded expectations, reinforcing ARM as the compute platform for the AI era. AppLovin. I'm seeing a lot of AppLovin. I guess maybe I did that to myself because I set that as the call thing. I just would love to hear from them above 500. They had a good quarter, though. Like, they're growing at 60%. EPS is above like 113% year over year growth. Can't deny that. That's amazing. Yeah, Fortinet did great. DoorDash did a good quarter as well. Coherent's growing well, but they have every tailwind at their back. Sezzle. Let's see this name really quick. The engagement flywheel we built is working, and our strong first quarter performance gives us confidence to raise full year 2026 adjusted net income guidance to $180 million and adjusted net income per diluted share guidance to $5.10. Average quarterly purchase frequency reached a new company high of 7.1 times, and active subscribers grew 48.4% year over year, reflecting the growing value customers see in Sezzle. Wow. They did buybacks. They authorized a larger share buyback program of $100 million. They beat on top and bottom line and raised guidance. That is a crushing quarter from Sezzle. Company's up 57% over the last year, but at one point was at $186. Wow. DoorDash finding higher highs here. What's going on here? Well, not higher highs. They're 52-week highs, 285. So they've got more to grow. But they bought back a ton of shares. They said we had a strong start to 2026 with rigorous execution across our business. All right. Apple fall during the call. Just watch. Dutch Bros down 5. What the heck happened here? Maybe climbing back. Did we get Dutch Bros numbers yet? I thought we did. I thought we reported on them already. Yeah, it was a double beat. 16 cents versus 15 cents expected. EPS grew by 14% year over year, and revenue grew by 31%. Zillow is falling roughly 8%. And AppLovin, wow, like almost losing all that run. We were up quite a bit, like almost 10%. Then that just disappeared. ARM is running. That is yeah, I'm pretty sure Sezzle is a buy now, pay later company that builds your credit. Chime crushed earnings. Do we even get their numbers yet? Chime. Revenue beat expectations. Guide was higher than expected. Full year guidance was raised. That's a beat. That's a triple beat. Wow. ARM running. What the heck happened with ARM? Okay, we need to go hunting here. Let's go find what's going on with ARM right now. Okay. I have their call here. I don't have their actual. Where's their actual press release? Okay, I have it here. This is for ARM. This is their fiscal quarter. Licensing and royalty revenue. Total revenue is up 20%. Royalty revenue is up 11% year over year, driven by the continuous adoption of ARM technology with higher royalty rates per chip, such as the ARM v9 architecture and ARM CSS, and increased usage of ARM-based chips in data centers. License and other revenue was up 29% to $819 million, driven by continuous strong demand of ARM IP, as well as fluctuations in the timing and size of multiple high-value license agreements and contribution from backlog. Annualized contract values continuing to climb. Stock is up 12%. And 98% non-GAAP gross margins. Oh my gosh. Wow. I always love whenever a company that's like this big makes a presentation that looks like this. It's always so funny to me. It's like you're talking about how much AI you use, and then you have like Microsoft Paint level, like Amazon does this with their presentations. So funny. Okay. ARM's opportunity spans 3 areas with shared growth drivers. Each benefit from market growth, share gains. ARM v9 and CSS platforms drive royalty rates across cloud, enterprise, and wireless and edge. They got chips in personal AI and computing, PC and tablets, robotics, autonomous vehicles, across cloud, edge, and physical platforms. $252 billion market cap. SoftBank is laughing to the bank, man. That's amazing. When's AppLovin's earnings call? AppLovin will be at 5. IonQ did not miss on EPS, I don't think. I think you're reading in the wrong one. I think they actually like crushed EPS. Let's listen to IonQ. I want to hear their initial reaction. They start at 4:30. So I get to hear what they have to say, and then we'll switch to AppLovin at 5 o'clock. But yeah, I'm pretty sure it's something crazy, like a 500% beat. Snapchat ended relationship with Perplexity. Okay. All right. Not good. That didn't last very long. AppLovin only up nearly 2%. I can't believe they gave all that up. We need to find the, or maybe Fiscal AI will have it up already. Fiscal AI has it up. Yep. Okay. Let me drop this really quick. Let me throw this up. So I don't follow AppLovin too closely, but why are we seeing this major decrease in total revenue growth? Is that because they sold off that segment of their company? I know that they, yeah, that is lapping. That's lapping the in-app purchase revenue. Or sorry, no. Yeah, what am I saying? The in-app purchases revenue versus the advertising revenue. Now it's all just a software platform. So they had to lap some of that year over year. Okay, so that's why the growth rate had slowed a little bit. And that's why it's, fine. Gross margins continuing to climb almost 89%. That's actually one of the things that's nuts about ARM whenever we look at their earnings. Look at this frickin' margin, 97.85%. Like, that's just insane. Okay. Operating margin was 78%. Holy crap. And then we look at margins for net income. 65% net income margin. Wow. The street is needy, bro. That's crazy that we're not 48 times PE, lapping an older segment of growth, still growing at 24%. I get it, man. But like next quarter, they're going to crush on growth if they keep up this rate. Okay. IonQ's call should be starting soon. I want to listen to that, and then we will switch over to we'll be switching over to AppLovin to listen to the rest of that call. Okay. Let's make sure that okay. What a weird platform for their live stream. Okay, let's take one last look at the stock price before we switch over to IonQ really quick. That's up 4%. Clover Health's up 2%. Flutter's up 3.9%. Fortinet's up 16.5%. Fastly down 22%. It's not looking like the recovery is going to be easy. Sezzle's up 14%. Redwire's down 6%. DoorDash is up 11.4%. Chime is up 3.3%. I want to take a look at this as well. AppLovin flat, if not going to turn red on earnings. That is just so criminal, man. IonQ. Maybe Quantum's the next big thing. I got to listen in. I don't want to fall behind. Old dogs can learn new tricks. Okay, their call is expected to start right now, but I'm listening to it, and it's just music. Just started investing in stocks rather than ETFs. IonQ could be my first double bought in at 29. What a stock to start buying individual names. You're like, you know what? I feel confident in buying my own companies. I'm going to bet on Quantum. It's risky, man, but you got in at 29, so that's it. That's awesome. Okay, let's see if the call is on. It's still not. Why did Shop get killed? Okay, call is on now. Let's listen to IonQ for a minute, and then we'll switch.
The star key followed by 0. After today's presentation, there'll be an opportunity to ask questions. To ask a question, you may press star, then 1 on your touch-tone phone. To withdraw your question, please press star, then 2. Please note this event is being recorded. I would now like to turn the conference over to Hanley D'Onofrio, Director of Investor Relations. Please go ahead.
Good afternoon, everyone, and welcome to IonQ's first quarter 2026 earnings call. My name is Hanley D'Onofrio, and I am the Investor Relations Director here at IonQ. I'm pleased to be joined on today's call by Niccolo de Masi, IonQ's Chairman and Chief Executive Officer, and Inder Singh, IonQ's Chief Operating Officer and Chief Financial Officer. By now, everyone should have access to the company's first quarter 2026 earnings release issued this afternoon, which is available on the SEC's website and on the Investor Relations section of our website at investors.ionq.com. Please note that on today's call, management will refer to non-GAAP financial measures. While the company believes these non-GAAP financial measures provide useful information to investors, the presentation of this information is not intended to be considered in isolation or as a substitute for the financial information presented in accordance with GAAP. You are directed to our earnings release for a reconciliation of adjusted EBITDA and adjusted EPS to the closest comparable GAAP measures. During the call, we will discuss our business outlook and make forward-looking statements, including those regarding our guidance for 2026. These comments are based on our predictions and expectations as of today and are not guarantees of future performance. Actual events or results could differ materially due to a number of risks and uncertainties. Therefore, you should not put undue reliance on those statements. We refer you to our recent SEC filings, including our annual report on Form 10-K for the year ended December 31, 2025, for a more detailed discussion of those risks and uncertainties. We undertake no obligation to revise any statements to reflect changes that occur after this call, except as required by law. Now, I will turn it over to Niccolo de Masi, Chairman and CEO of IonQ.
Thank you all for joining us today. 2026 is off to a strong start at IonQ, and our results this quarter serve as a powerful validation of what we built throughout our transformational 2025. Financially, we have delivered the biggest quarter in IonQ history thus far, and our fourth consecutive quarter of record-breaking results. $64.7 million of GAAP revenue in the first quarter of 2026 is more than 8 times what we delivered in the same period last year. Our strong momentum is a testament to the demand for our industry-leading quantum computers, as well as the commercial impact of our entire quantum platform. As I outlined on our fourth quarter call in February, a key objective for 2026 is to drive superior financial performance by leveraging our scale and quantum product families, combined with increasing geographic breadth and depth. We are executing well and have today raised our full-year revenue expectations to $270 million at the high end. Our results were underpinned by accelerating global quantum computing system sales, increasing high-margin cloud utilization, and deepening application layer partnerships with our enterprise customers. I am tremendously excited about IonQ's ecosystem progress, which was on full display at the New York Stock Exchange when we rang the bell with over 50 customers to celebrate World Quantum Day. IonQ is defining the quantum technology market and establishing the leading hardware and software quantum industrial ecosystem. Our organic performance is a direct reflection of this leadership as we architect and deliver the quantum platform for the next century of computation. We continue to widen our lead across commercial and technical frontiers. Our parallel gate architecture with electronic qubit control will allow us to solve problems at a scale and cost that we believe will be unmatchable. On April 14th, we rolled out clear third-party validated benchmarks, showcasing the incredible time to solution and cost to solution advantages that our quantum computers already possess. These metrics represent the speed and economics with which our systems deliver accurate solutions to the world's hardest problems. As you can see on slide 6 of our investor presentation, we presently enjoy up to 10,000 times faster time to solution on key quantum algorithms, including 1,000 times faster for the quantum Fourier transform. The quantum Fourier transform, in fact, enables many critical use cases, such as cryptography, molecular drug discovery, advanced material synthesis, and unlocking fusion energy, making this time to solution valuable today and into the future. It is not a coincidence that several of the key utility scale applications described by DARPA's quantum benchmarking initiative could take advantage of quantum Fourier transforms under the hood. IonQ's time to solution advantage with quantum Fourier transform and other benchmarked algorithms today underscores our fidelity and connectivity advantages that we expect to endure throughout the coming decades. I am proud to report that we have pre-sold our first chip-based 256 qubit system in the first quarter. We are moving with conviction to demonstrate this technology by year-end, with customer systems expected to begin commissioning by the end of the second quarter of 2027. While much of the industry remains in the scientific research phase, IonQ has been able to focus on delivering production-ready systems that are shaping the quantum market globally. We remain the first and only quantum company in history to have demonstrated the critical technology components at the performance levels required for full fault tolerance. The next critical frontier in our industry is the efficient use of quantum error correction to convert high-quality physical qubits into even higher quality logical qubits, unlocking new frontiers of scale and impact. This is the bridge to utility scale, fault-tolerant quantum computing, and it should be no surprise that IonQ is leading here as well. Just last month, we published our complete architectural blueprint for our flexible modular framework that describes how our technology scales through to 2030 objectives of a fully fault-tolerant system with millions of physical qubits and logical error rates as low as 1 in 1 trillion. Our walking cat paper described IonQ's end-to-end architecture for full fault-tolerant quantum computing, spanning compiler design and error correction to hardware, control systems, and ion movement. This historic paper outlines in manufacturable detail how we will move from today's IonQ commercial systems to deploying and commissioning IonQ's utility-scale quantum computers to customers. The level of detail and completeness in our blueprint is a global first and historic milestone for the quantum industry as a whole. Along with the academic community, there has been strong and broad recognition that this is the industry's first clear, detailed, manufacturable path to scaled fault-tolerant systems. For those able to follow along in our investor presentation, please see page 7 for details. IonQ's specificity sets a new standard and distinguishes IonQ with its tangibility, resting on capabilities our hardware has already demonstrated, including 99.99% 2-qubit fidelity and reliable ion transport. This historic work demonstrates precisely why IonQ is on track to be the first to unlock fully fault-tolerant quantum computers, as we published clearly in June 2025. Our level of transparency is only possible through our 30 years of innovation. Only IonQ has the operational maturity and engineering predictability of generations of deployed systems as we now accelerate into a new phase of manufacturing and scale. Moving on now to SkyWater and our merchant supplier activities. As most listeners know, in January of 2026, we announced our intent to acquire SkyWater in order to accelerate the U.S. quantum industry and deepen our commitment as a merchant supplier. We expect the transaction to close in the second or third quarter of 2026, subject to customary regulatory approvals. Over the past quarter, our commercial collaboration with SkyWater has already yielded multiple test iterations for our 256-qubit chip. As we shared in February, we hit the ground running with multiple initial tape-outs. Today, I am pleased to report that we have already received some of the first ion trap samples back from SkyWater and have demonstrated on these sample chips the critical performance we need for the complete 256-qubit chips. To design, fabricate, and test these chips with SkyWater within a single quarter has been a delight. Our commercial partnership with SkyWater is a demonstration of the kind of acceleration we hope our investment will bring for all customers of our quantum merchant supply function. And we expect these benefits to grow even further once the combination is complete. We already act as a merchant supplier with our industry-leading atomic clocks, sensors, and networking products being sold to other quantum companies. When the SkyWater transaction closes, IonQ will be the largest quantum merchant supplier in the world, with Thomas Sonderman continuing to lead SkyWater. We view this transaction as not only accelerating IonQ's commercialization of fault-tolerant quantum computers, but also using our balance sheet to secure the scalability of the entire US and allied quantum market. As it is a frequent question from our community, I will now walk through our application and quantum algorithm momentum in a bit more granularity than in prior quarterly calls. This work can be seen in our investor presentation on page 8. Applications and quantum algorithms are another cornerstone competitive advantage for IonQ. We know that for customers, value is measured not just on a machine's architecture, but by how that architecture ultimately delivers customer value and results. We are confident IonQ already delivers a potent combination of orders of magnitude faster time to solution, the most accessible cost to solution, reliability, and quality that customers cannot find anywhere else. We have more than doubled our quantum algorithm and applications team size in the past few quarters in response to strong demand. We continue to grow internationally, adding both application engineers and field engineers to support customer appetite for implementing IonQ's quantum solutions in their organizations. We are deliberately focused on early advantage verticals, pharmaceuticals, financial services, energy, and logistics. Real-world examples from just the past few quarters include the following partnerships. In the financial sector, we ran the world's first large-scale portfolio optimization quantum algorithm using real S&P 500 data. This showcased, along with Kipu Quantum, our systematic improvement in portfolio quality and execution time in a production environment. Our trapped ion hardware has a long-term structural advantage for dense portfolio optimizations such as these because of its all-to-all connectivity and its industry-leading single qubit and 2-qubit gate fidelities. With Synopsys, we demonstrated accelerated computer-aided engineering workloads through quantum-enhanced graph partitioning. We achieved double-digit percentage advantage in end-to-end time for large-scale structural models, such as a Rolls-Royce jet engine and automotive models also. Crucially, this demonstration was integrated into their existing cloud workflow with zero new infrastructure required. Einride is using IonQ to optimize shipment allocations and fleet orchestration for electric and autonomous freight, delivering measurable gains in real-world logistics efficiency. We have already demonstrated real-world commercial validation using anonymized logistics data and historical cancellation logs. By achieving an increase in shipments delivered, this work will underpin very significant revenue gains for our partner at fleet scale. With Quantum Basel, we are advancing hybrid quantum classical techniques to optimize large language models and reduce energy consumption. Our results show that IonQ quantum computer energy consumption scales approximately linearly with qubit numbers for shallow circuits. By comparison, classical simulation exhibits exponential scaling. We are on track to demonstrate significant energy savings with improved inference performance as we scale these capabilities. These 4 production-oriented applications are just some of the examples our customers are deploying to actively drive business advantage and growth. We are proud to announce in parallel that our work to positively and powerfully impact humanity itself has this quarter seen a step change. We are now working with participants from the Welcome Leap initiative out of the UK, which is a program designed to accelerate human health, to apply our quantum optimization to improve cancer research. Our work introduces new computational approaches for reconstructing difficult regions of DNA that are often missed or misread by existing methods. This could become a useful foundation for future studies of genetic changes that matter in human disease, including cancer. Last quarter, we also announced a commercial partnership with CCRM, which is one of the world's leading accelerators for advanced therapies. We are very excited about the work we are doing with them, which includes cell and gene therapies for cancer and immune system rebuilding. This work is truly world-changing, offering a powerful new future for human health. We have also begun work on combining our quantum optimization technology with computational methods for gene therapies. That includes optimization of mRNA sequences that get delivered into cells. Long-term, we anticipate personalized medicine acceleration. For those following along in our investor presentation, this can be seen on page 8. Let us now turn to the rest of our unique and expanding quantum platform. Building on the momentum of our recent deployments of quantum communication networks in Switzerland, Romania, and Slovakia, IonQ has now successfully deployed Poland's first national quantum communications network. This is one of the largest terrestrial quantum key distribution networks in Europe, and it cements our position as the partner of choice for sovereign quantum security. We are similarly expanding our quantum platform leadership domestically by announcing a new statewide quantum networking initiative in the great state of Florida, and the first commercial sale of a quantum memory node into the Mid-Atlantic Regional Quantum Internet, hosted at the University of Maryland. These partnerships underscore that IonQ is proudly playing a central role in the development of our secure national quantum infrastructure. On the technical front, we continue to innovate and lead the market as the only public company with a scaled quantum networking division. Last year, in partnership with the Air Force Research Lab, we achieved the first qubit to telecom frequency conversion in a field deployable system, enabling real-world quantum networks on existing telecom infrastructure. Last month, on World Quantum Day, we announced that in conjunction with AFRL, we connected qubits from 2 separate systems. This is the first demonstration of connected commercial quantum computers, demonstrating the operationalization opportunity of quantum interconnects and paving the way for distributed quantum computing that will underpin the future of secure global communications. Our contract with DARPA's HARC program is another testament to our leadership in quantum memory, modular quantum computing, and scalable networking architectures using quantum interconnects. IonQ is playing a critical role in enabling a new class of networked quantum computers that can combine multiple qubit types into an interconnected high-performance architecture. To our knowledge, we are the only industry player to win a hardware award as part of HARC. This contract is another powerful example of how IonQ is already serving as a leading merchant supplier to the entire quantum industry, with key IP, including the world's most accurate commercial clocks that matter to any modality's long-term scaling and manufacturability. Turning now to slide 9 in the investor presentation. Momentum remains strong at IonQ Federal. We continue to advance through DARPA's quantum benchmarking initiative and are building out our capabilities to support next-generation GPS, alternative PNT, and other mission-critical initiatives for our nation. We were awarded a $39 million contract to advance next-generation space communications under the Space Development Agency's HALO program. This paves the way for mission-ready quantum space systems for national security. Just this week, we expanded our space mission and sensing capabilities with a new product launch delivering persistent change monitoring intelligence from space. We were also awarded a spot on the Missile Defense Agency's SHIELD contract, which is focused on the rapid delivery of innovative capabilities to the warfighter with increased speed and agility. Our technology platform represents a dual-use advantage for our nation and its allies, underpinning both economic growth and national security. We are proud to be the partner of choice for US and allied governments in this geopolitical quantum space race. In order to do this work with US government agencies, high technology readiness levels are an imperative. Our quantum sensors and clocks have reached TRLs for deployment on land, sea, air, and space. At this very moment, we have quantum sensors currently deployed on a Navy ship and in space on the X-37B spaceplane. Our quantum security products similarly have already reached deployment-ready TRLs across critical infrastructure, telecommunications, and national networks. Providing mature, deployable quantum security solutions today is vital to ensuring continuity for communications as quantum computers become ubiquitous. Before I close, I would like to touch on Q-Day and talk through page 10 in our quarterly investor deck. Lately, Q-Day, the threshold where quantum systems render current RSA encryption obsolete, has dominated industry conversation. We have been transparent in our assessment of Q-Day's timeline since publishing our technology roadmap in June 2025. Based on our public roadmap, we expect to achieve the logical qubit count required to challenge RSA 2048 encryption in the 2028 to 2029 window. China's stated goal is 2029 in their government quantum efforts. It's worth noting that our peers have now recognized this accelerated timeline, with Google very recently bringing forward its expectation for Q-Day from the mid-2030s to 2029. As we continue to accelerate the timeline toward Q-Day, we view it as a strategic responsibility to also provide the solution. We are not just identifying a future risk, we are delivering mature, field-deployable hardware and software cybersecurity solutions that allow global governments and enterprises to both enhance cybersecurity today and ensure our nation's protection in the age of quantum ubiquity.
Okay, I'm all done with that. Everything is coming down right now on the markets. ARM was up a ton. Now we practically broke even on the in the after hours. AppLovin's down nearly 5%. Axon sold off, lost all their gains, down 4%. Kratos lost all of its gains, now down 3%. DoorDash climbing. Coherent crashed once showing off their earnings. Chime lost all of its gains, back down to flat. Sezzle still up to 12%. Core Scientific down 7%. Fastly down 28%. Oh, wow. Sometimes I have to wipe my eyes. I'm like, am I seeing that correctly? Like, what the heck is going on? That's crazy. You don't see that all the time where a single quarter, a company's valuation gets chopped by a third. Almost a third. Snapchat down 5.5%. IonQ was up. They're down 3.6%. Flutter lost all of its gains, down 3.4, up 3.4% now. TKO Group down 3.6. Symbotic down 6. It's not a great day for earnings, ladies and gentlemen. If you weren't a buy now, pay later name or DoorDash name, and those kind of go together like peanut butter and jelly. Buy now, pay latering your DoorDasher to come to your house and bring you a burrito. That's a shock comparatively to the last couple of days. Now, the earnings were actually good. Most companies beat. Chime had great earnings. We're going to take a deeper look at that. But we have AppLovin earnings here in the next 2 minutes. Let me make sure that I'm on the Zoom call. Actually, is there any way that I can join via browser? I would love a browser instead. Okay, cool. Says the thing will begin shortly. Was AMD earnings the top? No possible way was that the top. They guided for 35% growth for the next 5 years. So things should be looking up. But there's a possibility that we could take a cool, like a breather after a, really high jump after a little bit. Snapchat call, not a chance. I'd rather listen to AppLovin. Yeah, the quantum internet. Soon you guys will be watching me on the quantum YouTube. And, or at least hopefully you guys will subscribe to me on quantum YouTube. Okay. AppLovin is starting soon. Let's see. They can grow and still have their multiples compressed for a while? Absolutely. But there's not a need for that. Like, DoorDash has a PE, and this is before we end up seeing what this rise just did to their stock. But their PE is 78 times. This company is expensive. The companies that are selling off, like AppLovin, for example, 48 PE growing at 113% year over year. I don't know if that's overvalued. That seems probably pretty okay. We will see. AMD down 1% in the after hours, 416 still. Oh, okay. We're about to begin the AppLovin earnings call. Kratos, is that coming back? Kratos down 2.5. Thoughts on Fastly? I don't have any thoughts on Fastly. Whirlpool is down 20%. Whirlpool is down 17% right now. Oh my. That's crazy. IonQ falling. Okay, wait. Let's switch over to AppLovin call. Good luck, everyone. Enjoy.
26. I'm David Chow, Head of Investor Relations. Joining me today to discuss our results are Adam Foroughi, our co-founder and CEO, and Matt Stumpf, our CFO. Please note our SEC filings to date, as well as our financial update and press release discussing our first quarter performance, are available at investors.applovin.com. During today's call, we will be making forward-looking statements, including but not limited to the future development and reach of our platform, our expected growth opportunities, the expected future financial performance of the company, and other future events. These statements are based on our current assumptions and beliefs, and we assume no obligation to update them except as required by law. Our actual results may differ materially from the results predicted. We encourage you to review the risk factors in our most recently filed Form 10-K for the year ended December 31st, 2025. Additional information may also be found in our quarterly report on Form 10-Q for the fiscal quarter ended March 31st, 2026, which will be filed today. We will also be discussing non-GAAP financial measures. These non-GAAP measures are not intended to be superior to or a substitute for our GAAP results. Please be sure to review the GAAP results and the reconciliations of our GAAP and non-GAAP financial measures in our earnings release and financial update, available on our investor relations site. This conference call is being recorded, and a replay and transcript will be available for a period of time on our IR website. Now I'll turn it over to Adam and Matt for some opening remarks, then we'll have the moderator take us through Q&A.
Thanks everyone for joining us today. I want to start this call a little bit differently than our last few. No preamble on stock price, no addressing short sellers, no reacting to noise. This quarter, the conversation is about us and our future. And from where we sit, the future has never looked better. We just delivered another quarter where we beat our own guidance. Again, we continue to grow this business very quickly, despite the numbers getting much bigger. And we are doing it while margins keep expanding. The rate of top-line growth, profitability, and free cash flow generation that we are delivering is exceptionally rare in public markets, and our team deserves all the credit for that. What I want to spend my time on today is the opportunity ahead, because we are quickly moving through a lot of the goals we set for the business this year, and we are now well on our way to opening up our platform to the public in June. That is a major milestone. For 14 years, we have been a closed platform. Come June, advertisers across the world will be able to sign up for Axon and start running campaigns. That changes the trajectory of this company in a very meaningful way. Let me start with gaming because it remains the foundation of everything we do, and it is performing really well. A couple weeks ago, we hosted our annual Gaming CEO Summit. We bring in the top executives from the biggest mobile gaming companies in the world, and the energy this year was unlike anything I've seen. These companies have been our closest partners for over a decade in many cases, and the excitement was strong. There is a real sense that we are entering a new phase of growth for the industry, and our platform is at the center of it. Here's what is driving that excitement. First, AI technologies are now enabling these studios to do things they could not do before. Incumbent gaming companies, the ones that already have successful titles, can now use AI tools to improve their current games faster and cheaper. More importantly, it is giving them the confidence to launch new games. The cost of experimentation has come down dramatically, and that is unleashing a wave of new content that is really healthy for our ecosystem. Second, we are seeing a meaningful shift in how these companies think about monetization. Games that historically only made money from purchases are now really focused on testing hybrid models where they also unlock incremental revenue from ads. This is a big deal. For years, a lot of these IAP-only games would not run ads because they did not want to promote competing titles. But as we scale advertisers who are not gaming companies, whether apps or websites, e-commerce or other categories, which we now call our consumer vertical, those concerns go away. A cookware company or a fashion brand is not competition to a puzzle game. So we fully expect to see a lot of IAP-only games start monetizing with ads that will not be deemed competitive. That is going to be a strong tailwind for many quarters. Together, we and our gaming partners can acknowledge that our platform is driving the market's leading scale and return on ad spend and continues to help the industry grow faster than expected. The ad-supported part of the ecosystem continues to grow at really healthy rates, multiples faster than the growth of the more mature in-app purchasing category. As we look forward, we expect to see much more high-quality content come to market that taps into both ads and in-app purchasing monetization, and that plays really well into our strengths. Now that brings me to the consumer vertical, which is growing even faster than gaming. This is still only a 1.5 year old product. I want people to really internalize that. And it is scaling at a pace that gets us very excited. A couple weeks ago, we had another material model release that improves scale and return on ad spend significantly for our consumer advertisers. These are the types of compounding improvements we have talked about on prior calls. The team improves the model, advertisers see better returns, and they put more budget into our system. It is a virtuous cycle, and it is working. The consumer vertical exited the quarter very strong, with March growing roughly 25% more than the numbers we did in January, and April reaching a record month in advertiser spend, higher than any peak Q4 month. That kind of acceleration is exactly what you want to see from a product that is still early in its development curve. Advertisers are seeing real success on our platform, and they are ramping aggressively. We are thrilled that this is happening, and we are really excited about what comes next. When we open up our platform in June and start pursuing our mission of helping all the businesses in the world add another material marketing channel to their set of opportunities, that is when this thing just continues to compound. We've always said we want to help the smaller businesses scale. Last quarter, I highlighted an Israeli cookware company that went from $4 million in revenue to 16 million to now projecting 80 million, with the majority of their ad spend on our platform. That is the kind of story we want to replicate thousands of times over. As we look forward, one of the things that I'm most excited about is how advertisers will interact with our platform. We are already seeing advertisers use AI agents to manage their marketing spend, and we are building Axon to be natively accessible to those agents. Between self-serve access in June, our AI-powered ad creative tools, and agent-compatible infrastructure, we are building a system where an advertiser can onboard, generate high-performing ads, and scale campaigns profitably without ever needing to talk to a human. We're also showing up more: podcasts, sponsorships, a larger voice in the market. That visibility reflects a deeper conviction. Axon-powered growth isn't a niche phenomenon. It's a blueprint for transformation at a scale the world hasn't seen yet. Millions of businesses, that's the opportunity in front of us. Let me close with this. We're a focused company, more excited about our opportunities than at any point in our history. The gaming business is strong, our partners are energized, and we are helping the industry grow. The consumer vertical is scaling fast, and we are just getting started. Our platform opens to the world next month. We will continue to ignore noise, execute on our path forward, perform well, and drive value to our customers. We know that in turn, that will set us up for a much bigger future than where we are today. With that, I will turn the call over to Matt to walk through the financials.
Thanks, Adam, and thanks to everyone for joining us today. Q1 was another exceptional quarter. We exceeded the high end of our guidance on revenue and adjusted EBITDA, expanded margins to a new high, and continued our disciplined return of meaningful capital to shareholders. Revenue in the first quarter was $1.84 billion, up 59% year over year and 11% sequentially, driven by continued technology advancements across our core gaming business and our expanding consumer vertical. Adjusted EBITDA was $1.56 billion, up 66% year over year, representing an 85% margin. Margins expanded approximately 400 basis points from the same period last year. Quarter over quarter flow through to adjusted EBITDA was 86%, again reflecting the operating leverage of our model. Free cash flow for the quarter was $1.29 billion, slightly elevated due to interest and tax payment timing. As cash tax payments are weighted toward the second and third quarters, free cash flow conversion is naturally lower in those periods and will normalize over the course of the year to approximately 75% of EBITDA for 2026. We ended the quarter with $2.76 billion in cash and cash equivalents, providing significant flexibility to continue funding both organic investment and capital returns. During the first quarter, we repurchased and withheld 2.23 million shares for $1 billion, ending the quarter with 336 million shares outstanding and approximately $2.3 billion remaining under our share repurchase authorization, a program that continues to reflect our conviction in the value and durability of our business. Turning to our outlook for the second quarter of 2026, we expect revenue between $1.915 and $1.945 billion, representing 52 to 55% year-over-year growth, or 4 to 6% sequentially. Adjusted EBITDA is expected to be between $1.615 and $1.645 billion, with an adjusted EBITDA margin of approximately 84 to 85%. To close, Q1 was a beat across every metric, with margins at a new high and significant cash return to shareholders. Our capital allocation priorities for the balance of the year are unchanged. Fund organic investment and return capital through buybacks, reflecting our continued commitment to driving shareholder value through disciplined capital deployment. With that, let's move to Q&A.
We'll now begin the question and answer session. Please be sure to unmute and turn on your video before asking your question. We will take as many questions as time permits, and since we have many questions today, please be patient as we move through the list. Our first question will come from Matthew Cost with Morgan Stanley.
Hi, everybody. Thanks for taking the questions. I guess on the product roadmap, Adam, you talked about a significant product breakthrough just a couple of weeks ago. I guess, could you give us a little bit more detail about what that entailed? Was it a new type of model targeting a different use case, or was it an existing one? And then when we think about the roadmap forward from a product perspective, what should we be watching for signs of you continuing to expand that opportunity in, I guess, what you're calling consumer now? Is it about launching new models? What are the milestones that we should be watching for success?
Yeah, thanks, Matt. So if you recall, when we first launched Axon 2, we've had a lot of fast growth quarters since. I think it's been 12 straight. And most of that has been attributed to two things. One is releasing new products. So as we've gotten deeper into gaming, you know that we've come out with longer date periods of models. And the second and more important is improving the underlying model. And analogy is when you get to the LLMs, they can continuously uptick their model. They're releasing new models that perform better. In e-commerce and now what we're calling consumer, this product is really early. So it's like Axon 2, call it 10 quarters ago. We're going through the phase of not only rolling out a model and understanding what the consumer needs, but also then on the other side, getting more data into the system. As we add more advertisers, we get more data, then we can build a more sophisticated model that can process it and create better output. So we've been continuously doing that. Last quarter earnings, I mentioned, we just had one new model that had just created an uplift. The one we just had a couple of weeks ago was quite substantial. So that's why I highlighted on the talk track that we saw a big acceleration exiting the quarter. And then April Q2, bigger than any quarter that we had in Q4, which, as you know, most advertising businesses, I don't know of another advertising business, actually, they can grow Q1 over Q4. But when you're in e-commerce, normally the first half of the year is a huge drop against Q4. So already being ahead of where we were in Q4 prior to opening up the platform gets us really excited.
Got it. Great. And then just on, you mentioned the Gen AI creative tool. You've been talking about that for a couple of quarters, but I think you're in the process of rolling it out more broadly. So I guess, how is uptake there? And then I guess more importantly, for the advertisers that are using it, what sort of impacts are you observing from that?
Yeah, so I mean, as you know, we've talked about in past quarters, the creative placement on our platform is much different than anywhere else in the world. I'd argue it's the best ad there is. You get over 30 seconds of viewer time, and the user can't do anything else. So they're watching our ad, and the brand can deliver a really thoughtful message there, and then go to other steps in the ad that can drive transaction. Because it is so different and unique, advertisers have a problem coming to platform and investing in the creative resources necessary to make our platform scale. On the other hand, on gaming, we're the largest there is anywhere in the world when it comes to mobile gaming user acquisition. So creative resources are entirely dedicated to our platform. So the importance of this shouldn't be understated. It was critical for us to get a model on top of the popular image and video generation models out so that we can hand to advertisers the capacity to just create ads out of the box that work for our platform. We rolled out something called our interactive page generator earlier in the quarter. That's out to all customers. That has pretty widespread adoption at this point. But more important is the video side. That's still in testing. We're going to roll it out to all accounts shortly. And then that's important before we go to general release as well, because that was the point that I mentioned on the last earnings call. Advertisers trip up on is a lot of advertisers don't even have video for a platform like us. We'll hand it to them with these tools.
Great, thank you.
Yep.
Your next question will come from Omar Dasuki with BofA. Omar, we're not able to hear you. Perhaps you need to select a different microphone input.
Hi, can you hear me now?
We can. Please go ahead.
Great, thank you. I wanted to focus on the gaming business for a second, right? Because it kept on getting bigger and bigger. So the past several quarters, your quarterly run rate derived from mobile game advertisers has increased every quarter. And more specifically, the amount by which it steps up has also increased in the last several quarters. Did you see that trend continue in the first quarter? Do you expect it to continue the rest of the year? And how does your capacity to fund GPU capacity separate you from some of your competitors, who are also adding a lot quarter on quarter? Obviously, you're the biggest, but it seems like there's a number of firms growing here. So sorry, so a couple questions. Did you see the trend continue? Do you expect it to continue, for the step ups to get bigger? And how does your your ability to fund GPUs, separate you from competitors, if at all?
Yeah, Omar, you asked like you're almost surprised, but obviously we're pretty good at game advertising. I'd say with 2 less days in the quarter end coming off the holidays, to have that much growth in the quarter, Q over Q against Q4 is quite substantial. When you look at 59% year over year, large part of that still, because gaming is such a large part of our business, comes from the gaming vertical. We have yet, since we launched Axon 2, seen a slowdown. I also touched on a couple bullets that were important to understand on the talk track. We've got a lot of these IAP game companies that are really, really good at monetizing an existing game, now able to create more games at lower cost. Much of those more games will be ad supported and in-app purchasing supported. This hybrid category is explosive growth on our platform. So as you think about that, we're going into a period post growing really quickly, but one where there's going to be a lot more games from the highest quality developers and more games that are targeted directly at what we're very good at, ads and IAP. So at least thus far, we haven't seen a slowdown in growth. We've talked about 20 to 30% long-term growth in the games category. I think we mentioned that maybe 6 to 8 quarters ago. We've never had a single quarter that's come close to those growth numbers. We've been way over those rates, and we've never stated any different view on our long-term growth rates on the gaming vertical alone. I think you can sort of bank on that at this point. We're doing really well. On the GPU capacity, as the models get more complex, as we continue adding more customers, we're going to need more GPUs. We work with Google Cloud on it, and we can go to any cloud, but we have the GPUs that we need to process the business today. And it's very likely we're going to need to continue to buy GPUs. In the market we exist in, the amount of GPUs you have is not the direct indicator of who's going to have the most success. If you compare us to the mobile gaming ad platforms, we probably have the largest infrastructure. However, if you compare us to Google and Facebook, we certainly don't have anywhere near the largest infrastructure. And the reality is different businesses use infrastructure for different purposes. What makes our business really compelling is that for this space, we've written the best models and products for the advertisers. That's super critical. That's what allows us to do so well. And we process that data and create a better output than anyone else. And that technology lead, plus the data expansion, plus all the budgets being on our platform, first and foremost, drives the scale, growth, and success you've seen from us.
Okay, thanks. It was really a question about the quarterly run rate and how much it's stepped up, but I do appreciate the answer. Maybe we can talk in the after call about it. Thank you.
Your next question will come from Jason Bazinet with Citi.
So Adam, I've listened to you long enough to know when you say something a couple times, it's probably true. And you've mentioned this migration of in-app purchase games moving to hybrid monetization for a couple quarters now. And since you're pretty good at doing math on the fly, could you just spend a few seconds and just sort of give us your sense of sort of what the mix is today in terms of in-app purchase only versus hybrid? And if, pick a number, if 5% of the games go over to this hybrid model, what would that mean in terms of your top line? Like, how should we dimensionalize what it could mean for AppLovin?
Yeah, it's really, really hard to do that,
Okay.
especially on the fly. But I'll give you some qualitative points. The in-app purchasing market is mature. We know it's around $100 billion market. Most of the largest in-app purchasing games are some of our big advertisers. There's been a few that are new, but most are pretty old games. Almost all new games and a lot of these older games are really looking at this hybrid strategy because the growth in that hybrid category has been phenomenal. There was a company out of Turkey this past quarter that just with a dozen people roughly sold for nearly $1 billion about 6 months after launch. Vast majority of all their user acquisition was on our platform, hybrid game, and the growth was phenomenal. Got up to a 9-figure a year business literally in half a year. And so why is that? Well, the people who are likely to pay in a mobile game are probably all people on our platform, given we service adults. But at any given time inside a mobile game, sub 10% of the population will pay in a short window. And we optimize the 28-day window. Now, when you look at that and go, okay, if I'm a really good developer and I'm making an in-app purchasing game and I'm coming to this really strong marketing platform, Axon, and I'm only buying 10% of their audience, what am I doing? Well, let me go and layer on hybrid monetization. And what happens? 10x the market opportunity for that same customer. So these in-app purchasing developers are really starting to understand that there's massive growth in this mixed monetization model. You've got this ad-supported market that's much smaller, but as you know from the growth rates of all of our peers in the ecosystem and our own, has to be growing way faster than the single-digit growth rate in the in-app purchasing market. It's also starting smaller. Where it is today, I would guess is going to continue to converge to where the in-app purchasing market is over the next 5 years. And it's going to make it a really strong market opportunity for us and all other players in the ecosystem, given how much more available inventory there will be to monetize. Then what gets us excited is you pair that with all this extra demand that we're bringing in and the model improvements. And that's really what catalyzes all the growth that you've seen from us.
Thank you.
Your next question will come from James Heaney with Jefferies.
Yeah, great. Thanks for the question. Just one for Adam and one for Matt. So just for Adam, I think last quarter you talked about the breakage that you were seeing in your new customer onboarding flow. Could you just give us a progress update on that and how far below your target breakage rate you currently are? And then I had a follow-up for Matt.
Yeah, James. I don't know that we have a target. I mean, look, in any sort of platform, when you get customers on, whether it's social network or an ads platform, you're going to have some breakage. Our job is to give the best tools possible to the customers and really understand what the breakpoints are. The main thing that we talked about last call, resolving, we're still in the midst of resolving. We will over the next couple of weeks before we go to general release, and that's delivering video out of the box. That's not a trivial task, but we initially rolled it out a few weeks ago with customers. There's a blog on our website, so you can see some of the AI-generated ads. Frankly, the AI-generated ads are really, really tough to tell that they're built by AI instead of a human being, and the cost is exceptionally low relative to what a human-generated video would cost. So we think we're pretty close to having that ready to go for anyone to just plug in and get video out of the box. And then we talked about opening up the platform in June. So in a matter of weeks, we'll think we're there. We'll roll it out to the broader base of new customers and just get going.
Great. And then thanks for that. And then one for Matt, just on marketing expense for the second half of the year. I mean, is it fair to say, obviously you've got Axon launching broadly in June. I mean, is it something you're looking at kind of I don't want to say pumping up, but bumping the marketing expense higher in the second half? Like, how do you think about that investment?
Yeah, I mean, we've communicated this in the past, James. We're spending performance marketing the same way that our customers do. So we're looking at the return from that spend, and we're only investing where we can do that in an efficient and a profitable way. So we might see some increase in sales and marketing costs associated with the general audience launch and just this ongoing, building of our overall brand awareness as well, that you've seen Adam doing more podcasts that you mentioned in the preamble as well. So, we'll be spending more costs. And so you might see some, temporary increase in the sales and marketing costs associated with that. But over time, if we're really ramping up spend, it should be a positive signal to investors and to the market that we're seeing really profitable returns coming from that. So it should be, received very positively.
Yeah, a couple other cool stats I pulled before the call on that too is we're still running under 30-day break even on the dollars we're spending. We're doing a mix of paid marketing and sponsorships. So you might have seen us on some podcasts. You might see the ads on social media. You might see the ads on search. We're going to keep doing that, but we're very disciplined about what we do. We're not in a rush to go really sprint at this opportunity because at the same time as it's really important for us to bring advertisers on, we need time to keep improving our models and our products. And as you know, every time we do that, everything lifts with it. And then secondarily, I was looking at right before the call, what's the actual value in the front year of a new customer? And our business, as you know, as customers retain over time, the growth that'll happen to the cohorts will be pretty material after the first few months to the front year to the following years. We almost never churn customers once they get through the first 30 days on our platform. Right now, we're projecting well over $70,000 a year from every new customer. So if you just want to size that, if we open up the platform and sign on 100,000 customers in the next year, first year revenue from them or advertising spend would be roughly $7 billion. And then you start stacking the cohorts up. So the market opportunity for us, now that we've seen that the ticket size is pretty material, even though we've opened up the platform in part through referral, is really, really large. We just have to go execute on it.
Great. Helpful. Thank you.
Yep.
James.
Your next question will come from Stephen Ju with UBS.
Okay. Hi, Adam, Matt. Thanks for taking the time. I guess I don't want to split hairs here, but Adam, you've started to talk about the broader consumer segment instead of just the narrower e-commerce definition. The retail opportunity is, of course, pretty large, but as you think about the rest of the ad market out there that could be spending with AppLovin, can you talk about how easily transportable your current efforts will be to some of the other verticals? And secondarily, I don't know if this has ever been a concern, but versus the amount of inventory that's out there, how much incremental inventory do you think can be realized with some of the IAP-only publishers as you start to bring them advertisers that do not necessarily compete with them? And should we be thinking about the sales cycles to these publishers? It's not going to be that difficult because you're hopefully going to be showing up at their doorstep with lots of cash. Thanks.
Yeah. So great question, Stephen. So let's cover the second one first because I can remember right now. We'll go back to the first one. So the second one, inventory expansion is pretty important for us over time, but not necessary right now. We have over 1 billion daily active users, and we under monetize what we show right now. As you know, our conversion rate on 1,000 impressions is pretty low to a revenue generating event for us, and that's only going to go up as the models improve and advertiser density improves. But there's a couple of logical places to go to get inventory. So as you talk about in-app purchasing games, if you just start with the $100 billion market and say Activision, when they were public and they used to report king ad revenue, they'd gotten it to 15%. Let's just take that as an estimate, $15 billion a year to the publisher. And then obviously revenue on top for ad networks. Most of those apps today don't run ads. So if you say, let's say even half of them do, now you have a $7.5 billion opportunity to publisher. There's a massive supply side expansion for us. That's sort of sitting there pretty easy out of the box. We're going to go after that in short order. The other side of this is important to understand is as we go and get more publishers to look at us as an advertising monetization platform, we're not competitive with really anyone in the world. So you can imagine any type of publisher that's sitting out there outside of the really big walled gardens are going to want monetization support. It's not particularly easy to place a game ad on a social network or a music streaming site or a show streaming business. However, you can imagine e-commerce would place pretty well. And tied back to your first question, things like lead generation and things like fintech would place really well as well. And so as we start going out to these other categories, build the models for them, bring on the demand, in parallel, we're going to go to get more supply, both on mobile and then hopefully execute on the connected TV strategy as well. So this is all on our roadmap. It's stuff that we're actually working on and thinking about today. It's not stuff that I would say for 2026 is going to have any material financial impact. But as we think about our business, our job is to execute on things today that'll help the coming years. That's one of the key bullets that we care about. Now, on the first question of advertiser demand expansion, I'll start with, we're never going to get into branding. We believe everything should be performance when it comes to advertisers. So if you think about our business today, almost all of it drives to revenue generation for advertisers, but we're missing a huge category, leads. If you think about some of the biggest advertisers on social, you've got e-commerce, you've got gaming, you have apps that drive to subscription. So those businesses are all revenue generating businesses. We do that well. The other huge category are things like auto insurance, health insurance, fintech, food delivery. These are things that are structured around a lead. Now, we're missing that today. We're in the midst of testing a model around that right now. And as we roll that out, we're going to be sort of in the early stages of what we were when we rolled out the original consumer vertical, what we called e-commerce 6 quarters ago. We'll be at that same stage, but that's something that we're going to invest in. We're going to go service those kinds of advertisers. The billion-plus daily active users are not just gamers, as we've proven. They're also not just gamers and shoppers for D2C products. They're going to broadly want to do things. And so being able to service them with financial services offers, health insurance, auto insurance is a big part of our strategy.
Thank you.
Yep.
Your next question will come from Benjamin Black with Deutsche Bank.
Great. Thanks for taking the question. So Adam, on web-based, or I guess consumer advertisers across your existing customers, can you talk about the difference you're seeing across those who are having success and those who are not yet having success on Axon, and then maybe what you're doing to eliminate some of those points of friction before you open up the self-serve platform in June? And then secondarily, we're hearing more and more developers bypass app store fees, which obviously improves their margin. So as their profitability increases, have you seen a noticeable tailwind on the gaming side?
Yeah, the second one's easier, so I'm just going to answer that directly. We don't notice it. It'll flow into the ecosystem as it does. It's never going to be uniform. The game developer ecosystem is so fragmented, as is our advertiser base. So as they see benefits one-off, they might start investing, but game developers tend to be risk averse as well. So it's very unlikely that there's been a massive change in economics to the net to the game developer thus far. On the first one, you think, actually my mind's slipping up. Can you remind me of the question again?
Success versus not success.
Yeah. Okay. So when it comes to success versus not, we've talked about this before. Ad creative matters a lot. We put out blogs around this. We're trying to instruct the advertisers, but it turns out when we first launched this product, it was pretty easy to tell the advertisers to port your social media ads to our platform. That was sort of almost a trap in a way, because a 10-second ad that's meant to hook a user in 3 seconds is not very well suited to a 30-second video spot. And so what we've really been doing over the last 18 months with the customers is trying to get them to understand our placements are different. They need to really build creative for our platform. And then not only that, we're starting at a point in time where demand density doesn't exist on our platform. If you go to social, it's very rare that you're going to see the advertiser 5 times in a row. If you come to our platform, we're just getting started. And one, this is sort of a hindrance today, but a huge opportunity over time. If we think the user's in the market for a mattress, they might see the same mattress offer 5 times in a row. Now, that mattress company wouldn't have had that case in social. When it comes to us, if they serve 5 times in a row, they better have 5 times the video creative, right? Now, come a year from now, if we have way more home goods advertisers, because the density is inevitably going up, we would serve 5 different ads in those slots, which would drive our conversion rate up. So thus far, we've seen success with customers that know to invest in our platform for its unique attributes. And we've seen less success for those that think just port over what they're doing elsewhere, and that's going to work out of the box. Longer term, the opportunity on our platform is large. And what we're excited about is that the conversion rate's inevitably going to go up as we get more advertiser density and drive more competition, which is going to lower frequency of each individual advertiser to the end consumer.
Helpful. Thank you very much.
Yep.
Your next question will come from Alec Brondolo with Wells Fargo.
Yeah, hey, thanks so much for the question. I appreciate it. Maybe 2 for me. We track the number of apps and games that are being added to the app stores every month. I think that March was up something like 170% year over year. It's a pretty meaningful inflection. I think that these apps are probably going to be different than the apps that were on the App Store before. I think a lot of them are vibe coded. A lot of them are being created by prosumers. And I guess the question is, does the way that you distribute the mediation solution need to change in order to kind of reach this new long tail of games and apps that are being created? So that's the first question. Maybe the second question, I think, the kind of AppLovin creating a social media platform has been floating around in the zeitgeist for a couple of months. I think, it keeps coming up. You did a podcast maybe a week ago where you mentioned it again. And so could we maybe just get a little bit of clarification? Is there interest in building a social media network or maybe acquiring one? What is the thought there? Thank you.
Yeah, so the first question is a good question. Like right now, a lot of the vibe coded stuff in the world is quite a bit of slop more than substance. But as you go forward, what's going to end up happening is these tools are going to let the best developers create more content. Quality is going to go up, the content count is going to go up, and the need for discovery is going to go up. So that plays right into our strong suit. The better quality apps are going to need mediation. Integration with our mediation solution is really trivial. Anyone could integrate with our mediation solution using the popular vibe coding tools today. So there's nothing that we need to change there. Now, it's not our job to go monetize 10 cents a day monetizing apps. Like there's not a whole lot of value in the long tail. But so I would say we don't get excited over the flood of apps in the App Store today. What we get excited about is the ramification of vibe coding tools for the best developers today. They're only going to get better as we go forward. On the second point, I mentioned this on the podcast, we also can vibe code products. And there was once upon a time we bid on TikTok. So you know that we have an interest in better monetizing social. We believe we're very good at recommendation engine technology. We have one of the world's most sophisticated advertising technology. And the possibility to work on an engagement algorithm with a social app is enticing to our team. What we look at when it comes to the world of vibe coding and just releasing products is there's very little cost. But what it does for your business to be able to build new products is attract more engineers. Our CTO, Giovanni's job is to hire the best talent in the world of recommendation systems. And so the social media app is an example of something that will play that role. Not only will it allow us to attract great talent, that team's pretty excited about the things that they're building, and we're going to be able to test and iterate on a product in a very low cost and swift way because of the popular vibe coding tools out there.
Thank you.
Yep.
Your next question will come from Clark Lampen with BTIG.
Thanks, guys. Adam, I wanted to go back to, I guess, the hybrid conversion comments that you were making before. I think you said that net of those changes, developers were seeing 10x improvements in monetization. Is it possible to give us like a relative comparison or some relative framing of how monetization post those changes, or the bidding dynamics, I guess, post those changes compares between gaming advertisers and non-gaming advertisers? I think there's some concern that as density builds for the latter, that if they're bidding against a higher transaction value, that there could be some shift in the bidding dynamics that would be unfavorable for your gaming marketers. Is that happening, or are you seeing any signs of that occurring?
Yeah, I mean, look, that's a great question, Clark. Originally, when we got into e-commerce, now what we call consumer, we were a little worried, like, is this going to cannibalize the gaming customers? And we said, we are wasting a lot of impressions showing game. And the model, given the opportunity to personalize ads, is going to drive incremental transactions without cannibalizing. Now this business continues to grow. So we talked about the $1 billion run rate a year ago. It's much bigger now. And we talked about our fastest growth month. And then now in April, getting bigger than any month in Q4. So you see the trends where it's growing, and you just saw us put up a huge growth quarter where most of that growth is driven by gaming. So we have yet to see any cannibalization. There's not only is there an offset, which is we have a lot of impressions that we waste that now we can utilize for better targeted product ads. The other offset is as we get more e-commerce or consumer brands to go live, we get more data into the system. The more data we get into our model benefits both kinds of advertisers. So as we get more targeted with gaming ads, it's not likely we're going to see a loss. And then the third tailwind there, which frankly isn't up to us, is that these game developers I mentioned are getting more sophisticated. They're going to have more titles coming out, and they're going to be doing these hybrid monetization strategies, which paired with the App Store fee cuts are going to drive their monetization up a lot, their reach up a lot, and create this opportunity to really expand the ecosystem.
Okay, that's helpful. Maybe for the next question, going back to the top, and I think following up on Matt's question around the timeline for directed model improvements that we are seeing, you guys talked about, a conversion rate of around 1.3% intra-quarter. It feels, I guess, at least at a high level, like we're seeing a faster pace of directed model improvements of late. Is that, one, is that right? And I guess two, if so, is there something that you guys have figured out about your underlying models that is leading to a faster pace of improvement or some unlock there? Like, could the next 1.3% come faster?
I mean, like the 1.3% comes from advertiser onboarding and model enhancements. This is really a testament to the team. We're now further evolved at understanding how to improve these models, right? So they understand the techniques. They've gotten more sophisticated at what they're doing. The AI research space obviously is seeing fast improvement too. You've seen an insane amount of product releases in the large language model space in short order because of everything that's happening there. A lot of those same trends apply to us, but I think it starts with our team is just getting much smarter about the tests that they're doing. So we have 100% seen faster improvements to the models, both across the consumer business and the gaming business. And we don't really see a reason why that's going to slow down. As our team of researchers get smarter about the things that they're testing, the success rate goes up, which is going to enable us to continue to push the technology forward, drive better return on ad spend. That drives up same store growth. The same customers we have today should keep growing. And then pair that with opening up the platform and new advertisers and new data. It makes us really excited about where we're going.
Thanks, guys.
Yeah.
Your next question will come from Rob Sanderson with Loop Capital.
Yeah, good afternoon, everybody. I wanted to go back to the video creation tool you're in testing now, obviously. Is it mostly technology readiness that you're testing? I mean, is it too early for any learnings on how it changes spending patterns? Second question on that, I know you source multiple models, but any hiccup with OpenAI dropping Sora? And also, like, is Seedance 2 something you're interested in leveraging? Is that something you can leverage? And then as the product becomes more popular and you can see this scaling to thousands of customers, maybe more than that over time, but what are the implications for compute costs? And do you expect that's going to be a drag on margin? Do you think the revenue stimulus is much higher and maybe comes at lower margin, or do you think the business can absorb the costs, or do you think there might be some consumption fee or something like that?
Yeah, you got a ton of questions. I love it. All right,
you got to remember them all.
Let's see if we can keep them straight. All right. Like, video creation tool is new for us, so we don't have right now, like, in terms of adoption and total volume on the platform, it's pretty low. The job is to make sure that a customer can access the screen, request a video ad, and get an output that they're satisfied with. And so, like, once we clear that hurdle and there's not a whole lot of back and forth on that, we'll roll it out. So as I said earlier, I mean, we're days away from rolling it out, so we're in a pretty good spot with believing that the tool is ready. Now, we know for a fact more creatives that are catered to our platform drive up spend. That's pretty much standard. Like it's really not a complex task. So we think it's going to be very beneficial, especially for the smaller customers. There are big customers that make ads for our platform. So if you think about, like, the gaming companies, not as beneficial for them. They're already investing heavily in creating ads for our platform. I mentioned on the last earnings call, some of the top ones have 50,000 ads plus live at any given time. This tool isn't meant for them, but the tool is meant for the long tail that we're about to onboard and a lot of these e-commerce / consumer brands that just aren't ramped up on creative production. Now, when it comes to cost, which was your last question, we're going to roll it out where we're going to give them sort of an unlimited access. But if people start over delivering creatives, one, it's beneficial. It means the tool works really well. But two, it's a revenue stream for us. We can start charging, we can cap credits. There's companies out there that are raising tons of money at insanely high valuations. They're simply doing this. So if we see that kind of adoption, we could just start charging for it. And frankly, the cost is going to be so low compared to what they can generate in human generated creatives. That would be a really good sign for the success of what we're building here. And then, so I wouldn't factor this into our economic profile at all. I would not expect margin compression. This is also not our own compute. This is utilizing third-party services. So it's really just a tax that we have to pay to third-party services to utilize their compute. So then to your last question, which third-party services do we utilize, or how's the market evolving when it comes to image and video generation? Sora 2 is a good product. Obviously, it was one of the ones that we use underneath the hood. It going away doesn't change a whole lot. One of the nice things about being an independent company looking at all the large language models is we don't have to be favored toward any of them. And so you mentioned Seedance. There's other ones out of China as well. We can deploy any form of model, whether open source or closed source, in any of the categories, text, image, or video. and utilize the one that's best for the purposes that we have. And you can assume we do that. We don't stick to just one. We want to be optimized for the field. And so that's something that we constantly do. Therefore, Sora 2 being deprecated didn't impact us at all.
I know there were 6 questions, but I'm going to do a follow-up anyway. Just any learnings from the audience segmenting and targeting, like you went just prospecting campaigns to discovery campaigns, like any generalization on what this is doing to unlock budget for existing customers?
Yeah, I mean, look, it's simple. It helps. As you think about like the 3 different levels of targeting, we talk about it as going to the extreme top of funnel. The discovery tool is to send brand new site visitors, optimize them, and try to convert them for an advertiser. So this is site visitors the customer has never seen before. That's the extreme top of funnel. Then you go to a prospecting campaign that's sort of like you're going a little bit further down funnel, but you're still near the top where you're driving a new customer that's never bought before. So 0 retargeting, but something that is a new customer that might have visited the site before. And then our universal campaigns are a mixture of retargeting and not. And so by going from giving this targeting that we allowed the advertiser to go complete top of funnel, middle of funnel, and bottom of funnel, we're seeing that unlock much greater aggregate budget. Most customers that care about this or have these recurring high brand loyalty type of business models usually use a mix of all 3, and it gives them just more tools in the tool set. And so it is nice to do that for your customers. It allows them to break things down better. It allows them to change their budgets to better map to their goals. And we've only seen success since we've rolled out those other incremental targeting types.
All right, thanks, Adam.
Yep.
Your next question will come from Vasily Karasyov with Cannonball.
Good afternoon, Adam and Matt. So Adam, following up at what you mentioned a couple of questions ago, you mentioned connected TV, right? And I remember, I think for 2025, you listed connected TV as your 5 top priorities for the year, right? Obviously not getting a ton of attention, but can you explain your vision there? You say you will never do brand, right? You have Whirl, and by the way, Roku mentions Earl now and then in their shareholder letters that they integrate with them. So can you help us understand what your vision is and how what you're doing now will sort of evolve into that? Thank you.
Yeah, I mean, if you think about what happened, this e-commerce / consumer business just started growing really quickly. So we sort of shifted focus and said, we don't need to take a bunch of shots on goal last year. We said, all in, let's go make this product really scale. Let's build the Axon Ads Manager. Let's open up the platform. The opportunity was just too big to ignore. So we went all hands on deck on what was in front of us. That doesn't change the fact that I still believe television is massively under-monetized. And truly the holy grail of advertising when it comes to my view on advertising, defining performance as being able to drive actual incremental revenue for customers is to be able to take that small, medium-sized business that can't today access the big screen and let them buy the big screen and prove that they're driving incremental value. If we're able to do that, we can take the customers that we're acquiring now and be able to give them a click of a button to go to the television screen. That's something that we're still working on.
So I would say, take the creative that you generated for them and choose to place it on big screen somewhere. Is that
exactly right? And be able to prove to them that big screen ad drove more revenue for them than the cost that they were paying us on it. If we can do that well, that's a massively scalable business line. And it's also one that's really enticing to us because it's such an underused screen for performance marketing. It's overused for brand marketing historically. It's underused for a lot of these small to medium-sized businesses, and those are the ones that we really are building tools for. So if we can help them get there, it'll grow their businesses and it'll be really dramatic growth for us. That's something that we're working on. Now, as you've seen in the past, we work on a lot of things. We don't talk about things really until we know that things are going to work. It's easy to do extrapolation math, and you've seen us really signal new product is going to scale. And I don't know that we've been wrong once yet, right? Like, so this is early in development for connected TV. We're still working on it. At the point in time when it becomes something that's real, tangible, and we can extrapolate to big numbers, we'll start talking about it more. But I just laid out for you how we think about it. And we do think it's a big opportunity for us as a company in the long term.
Thank you very much.
Your next question will come from Jim Callahan with Piper Sandler.
Used to scale, how should we think about balancing the user acquisition needs between consumer, I guess now consumer and gaming verticals?
I think we missed the very first part of your question, Jim. Could you ask it?
Sorry. Just as e-commerce scales, how should we think about balancing needs between the consumer and gaming verticals on sort of the user acquisition side, making sure they're both sort of happy?
Yeah, I mean, look, we don't really think about that because, as I mentioned earlier to Clark's question, we haven't seen any cannibalization effect. And so in the absence of, our job is to continue to invest for both verticals. But the reason why we talk about the platform as a single platform is it's a single auction. It's our job to deliver as much demand diversity into the model so that the model can decide how to place the ad. Now, the two models we've talked about historically are different. So we continue to invest on the gaming side and we continue to invest on the e-commerce/consumer side. It's also our job to keep improving the underlying technology on both at rapid rates. So that's something that we haven't stopped on. Obviously, the gaming vertical for us is much bigger than anything else in our platform today. When we met with the gaming executives in Greece, they'd taken note of the fact that our models continue to improve. So we're not going and saying we're going to slow down on one in favor of the other. We're saying we're going to push both forward. And if we continue to see gaming growing really well, we're almost certainly going to see consumer growing faster. But because we haven't seen any cannibalization, it doesn't make us think about, okay, how do you balance the two?
Okay, that's great. Thank you. And then just one more on e-com. Talked about the step up in April recently. There have been a lot of sort of new product rollouts. Be curious what you'd kind of call out as like the biggest flag of kind of the improvement there.
I mean, the product rollouts help advertisers build campaigns, launch ads. Those are sort of like the basics of ad campaign management. A lot of that's going to be automated in the future too with agents. But the most important driver of our success, especially this early in the product, is the engineers improving the model to drive better return on ad spend for advertisers at a higher scale. So when we talk about we saw a big uplift, something that creates a big uplift across all is almost certainly to be an improvement on a next release version of the model.
Got it. Thank you.
Yep.
Your next question will come from Robert Coolbrith with Evercore.
Great. Good afternoon, guys. Really appreciate the opportunity. Adam, just wanted to get your response on a couple topics that maybe come up in conversations with some of the gaming developers. On the direct billing or web shops, obviously there's the cost saving side of the equation, but we also hear some developers talk about that as an interesting new surface area for data capture and remarketing. Do you think that's going to be a meaningful opportunity for the sector? And is that something that's potentially a good fit for AppLovin to develop a solution around? And then second, we also hear some people talking about some new creative or generative creative tools, things like playables generation and iteration or versioning. Is that something that you think fits in with the platform, could fit alongside some of the things that you're doing with creative clustering? Thank you.
Yeah, thanks for the question. So web shops is not a space we're going to get into directly, but obviously we benefit. So if the game developers have the capacity to get more user data, build a more intimate relationship with the user, launch things like remarketing, or even possibly ads on those checkout pages, those are things that we can play a role in. We don't need to be the one responsible for the billing, though. When it comes to the generative creative tools, it's not our goal to just stop on video and interactive pages. Eventually, we'll have playables. And hopefully, over time, using these tools, we can create more types of templates as well. There's no desire or expectation that for the rest of our existence, we're only going to serve videos and playables and gaming. It's very possible there'll be other types of ad formats. And as we get into high iteration mode using the LLMs, it's possible we'll land on new techniques too that can create better response from consumers. Now, today, the game developers already use a lot of these tools to create way more content into our system. I really doubt any customer created 50,000 plus ads by hand. So these tools are already benefiting us as a platform that's closed loop and this large scale, and also really for the game developer, the first destination. If they're going to spend money on AI tools to create ads, they're going to start with, let's create ads for the Axon platform, and then they're going to go beyond that. So we're already seeing a benefit, but I think that benefit will continue to grow as we get better at building out these tools ourselves.
Great, thank you.
Yep.
Your next question will come from Martin Yang with OpCo.
Hi, thank you for taking my question. My question first is on the consumer side. The strength you saw in April, if you break it down, is that from a newer cohorts that onboarded since 4Q last year or from a more mature cohorts?
Yeah, Martin, it's from both. I mean, newer cohorts are never going to ramp up all that much. So if you recall, I just mentioned, call it over $70,000 in the front year. So you're not talking about a lot of advertiser spend per month over the cohorts that we've gotten. So yeah, you could say like if we're seeing material growth, it almost certainly is coming from the current existing customer base as they see the product improving. What we care about is growth from those existing customers. If your current cohorts are growing much faster than expected, it's with certainty you're going to be able to open up your platform and get new customers. That's something that we just know is a function that's inevitable. We don't want growth from new to distract from the need to create growth from pre-existing. So we're always fixated on growth from current as the most important KPI that we want to see. And that's exactly what we're seeing as we improve the models.
The second question on the new features and tools you created for your consumer customers. What about the gaming side? Are those customers getting as many new features and updates as the consumer side?
Yeah, I mean, look, on the underlying model, the gaming models are continuing to evolve as quickly as the consumer side. So that's why gaming you keep seeing is growing really, really quickly. There's nothing that suggests we should be growing gaming at the scale that we operate at this quickly, other than we have to be improving the model really quickly. On the ad creative side, I just mentioned, like, these gaming companies are already really sophisticated. They don't need the tools to be ready for them as much as the consumer advertisers. It's our job to make the consumer advertisers scale, but then get better at these tools for the gaming customers as well. So I just touched on that eventually we'll have a playable generator as well. So we'll get into all these categories. But right now, because the tools are so early, the lowest hanging fruit for us was the consumer vertical.
Got it. Thank you. That's it for me.
Your next question will come from Ralph Schackart with William Blair.
Hey, Adam. Hey, Matt. Just two quick ones. Doesn't look like the macro impacted you in the quarter, but just kind of curious, Adam, anything you're hearing out there, particularly probably the e-com customers or advertisers with the oil prices where they are. And then talking to ad buyers inter-quarter, we're hearing retention rates were a lot higher than at least the people we've been talking to on the self-serve product. I'm just kind of curious if that's something you're also observing on a broader basis on your platform. Thanks a lot.
Yeah, I mean, like the first one, we don't tend to get much macro impact. We're selling revenue and profit to advertisers. So if they're buying profit, they're not going to come cut the dollar that's driving them the best ROI on their advertising. So it's not something that we really see. And then on the consumer side, where you'd say broader set of customers around the economy, most of our customers still are Western, as we haven't yet really launched an effort to go get customers around the world. So I'd say short is no impact from us, but I don't know that we have the visibility to even know. And it's very likely that just the structure of our business selling revenue and profit to customers makes us pretty insulated from macro trends long term. On the self-service retention rates, I guess is your question, are we seeing strong retention from self-service customers? Yeah, for sure. I mean, I mentioned a few minutes ago that if they get to 30 days of spend, there's first like get them live, which we're continuing to work to improve. But once they get live, if they get to 30 days of spend, customers almost never churn on our platform. So it's our job to get them there. But we see pretty low churn overall when customers go live relative to what you would expect on products like these. Because we're selling profit to them. So they launch, they see good return on ad spend out of the box. It costs very little for them to see that. Then they continue to invest in the platform. And that's why when we look at a product offering that today has less than a 30-day break even on the marketing dollars that we're spending, that's really exciting. Obviously, if you have really strong retention long term and those cohorts, net dollar retention is going to be pretty strong as well. And you break even that quickly, you're going to make a lot of money as you go get more customers.
Makes sense. Thanks, Adam.
Your next question will come from Tim Nollen with SSR. Tim, feel free to turn on your camera, unmute, and ask your question.
I'm ready.
We'll move to Jonathan Keys with Daywa.
Okay. Waiting patiently here. So glad to make it. And yeah, you guys can squeeze me in. I guess I wanted to ask a strategy question. You're now talking about this as consumer, which has many verticals. And in the past, you talked about going after transactional base, and now you're talking about transaction and lead base, talking about the three parts of the funnel. You know, the question that you guys, I'm sure, received when you're first going to go into e-commerce, and now it came to mind again as you talk about consumer with the many verticals. isn't it too much? I mean, you guys got really good because you focus on just one vertical, mobile games. It's just that you guys dominate that, right? And now you're taking that expertise over to e-commerce and the verticals within consumer, understood. But you're also talking about you have to have two separate models and stuff like that. And, resources can be scarce. That question pops up again. And in terms of, are you doing too much? And especially like you're still trying to gain traction with like, the video ad market, the TV ad market. So I guess that's I'll leave it with that. So.
Yeah, and look, it's a good question. We have a great team. People love working hard. They love the products that they're working on. And we've never reached the point of too much. I mean, it's one of those things where like, it's easy to look at how lean we are and think, okay, they can't do more. But these incremental products are things that we understand really well. Their goal is to go better monetize the audience that we have. And so as we talk about like launching cost per lead model, getting into lead gen, it's not a materially big lift compared to what we've already done, because we know really what we have to do. Then we talked about in the talk track, giving our dashboard access to agents or any of the popular LLMs. Eventually, you can imagine advertisers will just be able to use their favorite LLM, take all the action they need in our dashboard, automatically create the video and end cards, get live, get profits, get leads, scale. That doesn't require a lot of effort from us. A lot of this stuff in the world that we're going into is going to go automated. And then it's up to our team of really sophisticated engineers to build great product. And it's up to our business team to make sure that the business and growth marketing teams to make sure that our brand is recognized and the customers come to our platform. Those are things that overlap to everything that we're talking about here, whether it's the lead gen model or the connected TV model. So what gets us excited about that is all of these growth vectors, also including just getting more supply, are all really related to each other. And a lot of this effort is not meant for this year again. Like, we're not saying we're going to race after this opportunity and count on it this year. We don't need to count on anything this year. This business is growing really fast. What we're talking about is a whole bunch of related opportunities that are really large that will hopefully set us up for exceptional growth rates and profitability expansion over the coming years.
Great. All right. Thank you. Good luck.
And that concludes the question and answer session for this quarter. We thank you all for joining us today. Have a good afternoon.
Thank you.
Okay. That was a pretty amazing call. I gotta say, I was really I learned a lot, like in terms of whenever you just like go to break down, like, okay, did I learn something on that call? Was it bullish? Did they end up reporting very well? Yes, across the board. So that being said, the stock is for the most part unmoved. We're up 2% in the after hours after being down today by 2%. So if you had bought this company 2 days ago, I mean, it is what it is. Adam is a great CEO. He's exceptionally young, exceptionally rich. He's and he owns a lot of this company. A lot. You always like that, that alignment in your companies, right? So that's really important. And then in terms of the ad tech space, it's going to get to a point where a lot of advertisements are generative AI. I think that that's important. They're right there front and center, but I always worry with these ad tech spaces of like, okay, we don't think that Meta's going to be offering those things. Like, I know that that's like obviously app is one of the things, and they're going to be branching into so many others, right? Connected TV was one of them that they talked about, but it's just, it is interesting. I don't know. I guess that's what I'm trying to say. I don't know if I want to purchase the company just yet. And also, I don't know what's going on with ARM. I was listening to AppLovin, so I've got no clue what was said on the call. ARM did not raise guide in line with demand. All right, that's fair. Up 11% to down 5% to now up 2%. Yeah, I think you're even missing a couple of additional swings, but yeah, it's a lot. But ladies and gentlemen, this is that's pretty much it. Really do appreciate your time. Thanks for joining me. We'll be back online tomorrow. I also have a video coming out tonight for both talking about AMD and NVIDIA and sort of comparing the two. But ladies and gentlemen, thank you all so much for watching. Really do appreciate your time. But until next time, bye for now.